when we track mutual funds, we are relying on the ability of the fund manager to give the return. For example, in the last 1.5 years, if you look at a fund like a DSP small cap fund, look at a fund like a HDFC mid cap opportunities fund. Last 2 years, these are in red, -10, -15% losses. But that doesn't mean that you book your losses and move out. You would want to stay invested because you believe that when the cycles turn, if you've seen last 1.5 months to track the markets, small caps and mid caps have given between 30% plus returns. Just last 1.5 months. So typically how markets, when they give you returns, they may stay quiet for a long period of time. But when they give returns, it's a sudden spike. Right? And you miss out the bus. That is why the fact that you invest and stay invested. It's very difficult to time in that. For example, last year September, we had some of our investors put money into mid-cap funds because we found they were cheap. They fell further. And then our thing was stay invested. It's fine, they've fallen further, but you stay invested. But they've more than recovered the losses in the last 1.5 months when the markets have gone up. Right? So again, the trade is very difficult. If you are able to control your behavior in trades, then yes, I will stay invested. Then you are pretty self-disciplined. If you are not, then you need an advisor to do it for you.